Hi, this is Tom Alexander. I want to share with you some observations in the stock market, and really from an intermediate, with a focus more on an intermediate to long-term basis than short-term. I think the short-term here, uh, where we are at a really key inflection point that is going to determine perhaps the direction of intermediate and long-term time frames. Uh, the other thing that I'll make note of here that I'm sure you have noted is that there is this incredible amount of noise now in the news space, in the analytical space about the imminent direction of the market, that we're getting ready to explode to the upside, we're getting ready to crash and have some sort of 2008 type of event. And I've alluded to this before, and it hasn't changed. It's been this way now for several months. And I think this is going to do nothing but intensify. I have been expecting volatility to pick up, and the volatility has gone somewhat dead here in the last couple of weeks. But we've had a pretty interesting year that began in October, and I think that there are signs here that is likely to pick up again, just to see more volatility, perhaps in both directions, as this intermediate to long-term situation gets resolved. You know, there's certainly an exogenous backdrop, the political situation, the economic situation. You have Europe, all over Europe, you're in a recession. The U.S., apparently there's a debate on whether or not we're entering a recession, in a recession, not a recession, you know, all of this stuff. And that's why I lean on this work. That's why I lean on auction market concepts, because it takes me out of the noise. It gives me something that's objective that I can use, and I can use it to make trade decisions. I don't have to depend on someone else's opinion, macro or technical, regarding what's going to happen in the world. Now, it really is interesting right now, and just as an observer of social condition, it's quite fascinating. Let's start with the profile view, and I'm going to use the ES. I'll allude to some of the other contracts in a minute, the other three primary trading indices. But the ES, the Dow, and the NASDAQ are all basically trading in lockstep. Obviously, the one that isn't right now, and I've talked about this until you're probably sick of hearing me talk about it, is the Russell. But we'll get to that in a minute. Okay, so actually what you're seeing here. This is a profile view, yearly profile view. So as of July, whatever Friday's date was, hold on, I guess the 19th, July 19th, this is where we closed, and this is the profile for 2019 so far. Now, we're bumping up against the upper extreme of this profile unit. We have this large buying tail, and again, this is on a yearly time frame down here. You can see there has been a clear migration of value since the low in March of 2009. You know, you've had some periods where the market has gone basically net sideways. It did that from the end of 2011 into 2012. Then we exploded again. Then we went net sideways in 2015 into 2016. And then in November, we exploded to the upside into early 2018. We've been going sideways since. Now, you can make the case that 2018 and 2019 are the same auction. I'm choosing not to combine them into the same auction because in this particular instance, I think it's important to note the subtle migration of value higher this year over last year. And when I say migration of value higher, it's the 25% of the area of greatest transactions as denoted by the dotted magenta line here. So you can see we're trading near the upper extreme. I've also cautioned recently about fading new highs in the stockmkt futures because of any reason. Overbought, oversold, those are the two worst reasons to ever make a trade decision, because something is quote unquote overbought or oversold. There's no such thing. there's either trade facilitation or a lack of trade facilitation, and that's what you're reading when a market reaches a certain level. But the market is undeniably at an inflection point. I think it's going to move sharply away from here soon. Soon is a relative term. It may take, if you're looking on a time frame of a year, it may take a couple of months. But even now, within these couple of months, I think volatility, there are reasons to believe it's about to pick up. Now I'm going to go down in time frame to a weekly view, and you can see now this is quarterly, so each letter is 1 month of trade, and you can see that you can sort of get an eyeball idea of what a normal range is, and there's a wide range of normalcy in terms of what a quarterly range can look like. Certainly, it's not hard to figure out this is an extremely narrow range. This was a narrow range, and you can see what happened. It eventually broke out into a much higher range. So we are at, from a quarterly basis, we are in a very, very narrow range. We're trading near the low extreme of that range right now, but it's a very, very narrow range. And then below this level, there's the high volume node from the last quarter, which could be an important level to keep an eye on. And I'll keep you updated in the reports. That's actually, I think that's in the report the written report that I'm in the process of publishing for tomorrow. But there are more concepts than I wanted to take the time to write out, so that's why I'm doing this video. So anyway, so this is the weekly time frame, the quarterly time frame. Again, each letter is 1 week. Let's put this out. These are the 3 weeks of July to date. We're heading into the last week plus. I think there are 8 trading days left in this month. Obviously, the current overhang, exogenous overhang in the market is the Fed thing. The Fed's going to cut interest rates. Is it going to be 25 basis points? Is it going to be 50 basis points, et cetera? And that's going to be the excuse, I think, for the next sharp move. I can't trade that, though. I can't trade that. That's not information that's tradable. Case in point is what happened at the end of the last week, where we had the market turn on a dime because of something a Fed member said and traded straight up. And then the market on Friday traded straight back down when they walked that back. So you have to be, as I've always said, most market activity is noise. Even day to day now, it's noise, much less intraday. So let's go down to a daily time frame. And here's the day time frame. Now, a couple of subtle observations about the daily profile here. And you can see it's a very tight profile unit. This is, each one of these letters now represents a day. So it's a monthly profile. But this is day to day. You can see what a tight, for the past 3 months, we've really been in sort of a churn, and this is clearly an important low down here now. This June low, from where we bungee jumped strongly back up. So this high volume node is really important, and I think it's the most important high volume node from a practical trading perspective. I would not be surprised to see a sharp move into this before we take back off to the upside. Now, that said, and I'm going to show you why I think that in just a minute, but you can see you've got all this fat trading in here. You don't have this well-pronounced high volume node with areas of slowly decreasing value to the upside, slowly decreasing value to the downside that you sort of expect to shake out in a given auction unit of this duration, okay? So you're looking for range expansion in the auction just because it's typical. And this, what we have so far in the month of July, is not typical because there's so much back and forth guessing by major players as to what's going to happen. So it's creating this area of value in here. And you have a sharp reaction away from the low, or sharp reaction away from the high. And again, I'll point to the end of last week as indicative of that. Now, if we go down to the day time frame, each profile here is 1 day of trading. And let me do this. Okay, now each letter is 30 minutes in the session. Now there's this subtle migration of value lower into here, and then Friday we had the bungee jump up here. And this is where it's important to read the auction and not just stare at a profile graph to understand what's going on. If you look at this, you go, well, gee, Tom, values has changed back up here. And I'll go, well, yeah. However, if you look at the auction, price is down here. So now what's really important to the upside is this area back up in here. And I think even finer tuned than that is this area here that includes the Friday session high. So this area is really, really, really important now to the short term. If the market cannot exceed this area, I think it's going lower, and I think it's going lower sharply and quickly. Now, I'm recording this on, what time is it? On Sunday morning. So we'll know by Globex probably whether I'm right or not. If Globex gaps up and we open the day session up in here, then my thesis is probably wrong, and we're probably going to trade higher through this range. Now, I want to show you something else that I've been playing with. All right, you guys know that I use market internals, specifically NYSE breadth data, a lot in my analysis. And I always caution, it's a blunt instrument. You can't trade it rotely, but it can give you, I think it gives incredibly helpful information at certain times. Now, I typically use a 10-day moving average of advancing issues and a 5-day moving average of advancing issues. And that's pretty good, pretty useful information. And then, of course, there's breadth, which is sort of the speedboat in the channel if these are the battleships. This reacts on a day-to-day basis with expansion and contraction depending on what big money is doing. What you're looking at here is the red line. Now, what I have done, I have made this a 100-day moving average of advancing issues, and I've made the green a 50-day moving average of advancing issues. Just playing around, seeing if I could find some sort of correlation with past market moves. And there are a number of things I want to point out here. The biggest thing I want to point out is this incredible divergence between this kickoff high back in the summer 3 years ago and where we recently peaked out. And really, this is because it's 100 days. There's a lag here, but it's really reflecting this incredible ramp up off the December low. Now, you can see the December low, the 100-day moving average of advancing issues, the 50-day moving average of advancing issues had not been this extreme in over 10 years. And what was 10 years ago? Well, it was right in the fat part of the heavy decline in 2008. Back in October 2008 was the last time you saw readings like this. So there was reason to believe here that you were going to have a barn-burning rally of one degree or another. And indeed, we are still having a barn-burning rally. Now, we've broken into new all-time highs, and the market is churning in here. That's not too unusual. I can point you back to breakouts of all-time highs many, many times over the years. The first one, the one that really should give you pause is in 1995, 1994, 1995 when the market broke out, and everybody was talking about overbought for the next 2 years as the market went straight up with very, very little retracement. I'm not predicting that's going to happen, but I am suggesting at this point in time that that could happen. It could happen. Right now, I think the market is setting up for some sort of, based on Friday's trade and the real recent price activity, which is subject to change as soon as Globex opens up. I think this market is getting ready short term to sell off again. If you look down here at breadth, now this is clearly a short term instrument. It sort of boxed itself into a wedge, and you have the 100-day, you have the 50-day, and they're diverging against the recent highs as well, very, very sharply, very, very sharply. And I think some of this reflects the uncertainty about what the Fed's going to do and the impact it's going to have. So guys, I'm just, the next couple of weeks could be really interesting, could be really sharp. And I think the key is going to be, here's my best guess, and I want to emphasize it's a guess as to what we might see. I think what we might see over the next week or so is, and we're sort of overdue here to get a breadth reading of in this negative 2,000 area. I was looking for it way back in the spring, and it didn't happen. And I said at that point in time, if you go back and you look at the reports, we had the market that was declining in here, but you had breadth that actually was showing signs of strength. And sure enough, we had this furious bungee jump off of that June low. So this breadth work, I realize there are a lot of things that are different in the world. You have all this noise, but at times you really want to be paying attention to this. And this is one of the times that I am paying attention. Now, to me, the ideal scenario from a trade perspective that will give a lot of information is if we get some sort of sharp sell-off and we reach this negative 2,000 level down here, somewhere in here. And then I'm gonna change this now, and I've shown you now the longer term picture and the longer term concern. Now I'm going to go back to let me do this. I want to go back to a 10-day. Let me find it here. Let me do this before I screw this up. Just bear with me. Apologies. I'm going to go back to a 10-day here. I'm going to take this off. And then I'm going to go back to my 5-day here. Now let's take a look what we see here. I'm going to expand this out. Now you have the 10-day that is, it can't generate any strength, and it's been getting weaker and weaker and weaker. There's a subtle divergence beginning really here, but then each of these peaks is lower than the last peak. And here's the most recent one. So we're this trending lower. And look at the 5-day. You have the same situation in the 5-day. And then you have breadth that's sort of coiled into this wedge, but it's also very weak. You have these lower highs in breadth. And this sort of reflects a churning and an uncertainty. The market price-wise hasn't broken yet. Now, it could still break up. And, guys, I'm telling you, if this market breaks above this level, the recent high right here, that's a little bit higher than that, but you get my point. If it breaks above this level and you see breadth picking up, you do not want to be fading that. I mentioned this in a report a week or two ago about the potential for range expansion on the weekly profile, the weekly auction. You don't want to be fading that. Now, what I would like to see is I'd like to see a shot down into this negative, and I'm more interested in where breadth goes than I am where price goes, frankly. And if breadth gets down to this negative 2,000 level, then, you know, price is going to end up probably at somewhere here, somewhere here. It's a guess, okay? But if we do get that shot down in breadth and a contraction negative 2,000, then it will give us great trading information at this point in time. So I was just sitting here, did not really intend to really to create a report or anything, but I found the information that I was seeing pretty compelling and extremely interesting. So I think the message here is be objective, look at what the market is telling you, ignore the noise. If you want to listen to the news, that's fine. It's entertainment though. It is pure entertainment. It cannot be traded. You can trade this. So stick to the auction, stick to what you know and what you can trade, and you'll be far better off for it. So guys, enjoy your day. I'll see you in the room next week. A lot of you, the rest of you, I'll have reports out as needed in a timely manner.